going on? Phooey. It's been a minute. Today's July 9th for me. If Pyros and Cribs all got along. Alright, let's get into this. I just want you to take note of where I have my target at right now. It's at a new week or new day opening gap high. That's my original terminus. Terminus being target. So I want to go short here. Buy side has been rated. And today's video is going to be kind of a lot different from other videos. It's going to be more technical, kind of more of my technical analysis of like what I do during a trade. Here I get short, and I have a sell limit. My entry position was kind of bad, so I put the sell limit a lot higher, just to so that if it does get hit, that my average position is better, stronger. But right now I'm just looking for sell side liquidity to be rated. You can't really see the relative equal lows on the 5-minute chart on the right hand side, but on the 15-minute chart they were more visible. This is what kind of sucks about just using one monitor too, is you have like way less visibility of all the different time frames. Kind of fucks you up. Yeah, today's video is going to be kind of weird. So in this video I'll tell you how I identify a losing trade or an improbable outcome, how you can catch on to it. So when you have a target and while price is delivering towards your target, it keeps on taking out buy side liquidity over and over and over again. It kind of means like price can only be swept so much before a retracement has to happen. And a lot of that has to do with the macros. So the macros deliver price much more like violent, or like directly to the target. Whereas if you're in between macros or right after a macro, you can still get volatility in price, but it's more sluggish. And you'll see what I mean here. You see it's already, if you look from the left hand side of the screen, it swept price once, twice, and about to do it 3 times, which is fine. I mean, which is good, because I want price to go down. But if it does it too many times without delivering to my target, it creates an improbable environment, whereas like it's already swept too much, because price, it doesn't want to give people the chance to load up positions on every move. On the big like price moves, like what I'm aiming for right now, it's gonna do it quickly. Seems like the whole city go against me. Every time I'm in the streets, I hear here we go, I'm measuring it out. 50% of that price run, there's a little bit of liquidity. It's also the consequent encroachment of that fair value gap. So that's what I think I moved my take profit. But take note of the original take profit here, or my original target. It's the high or the low. I can't see. It's a new week opening gap high. That's my target, my original target. But because I noticed price is moving kind of sluggish, and it's just one contract, and that's a lot of range for one contract. Keep in mind, I'm trading all these trades. See, if I had 2 contracts, like I'm trying to get into another one right now, I don't think I end up getting. Oh, I wonder if you guys can hear that. jets coming in, flying pretty low, so it's loud. Probably can't hear it though. This mic kind of sucks. But yeah, this video is kind of, I mean, it's not really that bad, but it's kind of boring. But it's important to see, like, oh, it just switched over to a new clip. Alright, so now it's taking price on the sell side 1, 2, 3, 4. It's about to do it like 5 times. So when price keeps taking it like little by little like that, it's kind of like, yeah, it kind of wants to go down, but it doesn't seem like it ate its protein this morning. So it's like, it didn't have its protein shake this morning, so it's weak, and it's like, I don't really like feel like going that far down, but I do have a willingness to go down, maybe just not right now. So for me, finding direction in price action on a session basis is kind of easier than your executions. So so in trading, you have to know your bias, or have a good idea of bias. You have to have good executions. You have to have good trade management, which means how you load up your trades. So right now I'm just starting off with 1 contract, but people will start, once you start like leveraging your trades, meaning putting more contracts on a trade, there's a certain way you have to manage your trades, as in, okay, I'll start with 3 contracts, and then once price goes back up, depending on whether you're going for sell side or buy side. So let's say, like right now, I'm going for sell side liquidity. When price goes up, I'll add another contract, and that's trade management. Like, you're defining a criteria to enter or to add positions to your trade. Because when you're going for sell side, you never want to add more contracts when price is already going down, because when price goes up, you'll be getting a better price for your contract if you're going sell side. And then everything is vice versa for buy side. So if I'm going to add more contracts and I'm aiming for buy side liquidity, I want to add more contracts every time price goes down, because you're buying a dip and you sell the highs. I guess that's a more, but see how it's just taking sell side liquidity and it's not jumping to my objective. So for me, that just makes it improbable. And instead of forcing it to touch like my take profit, you have to accept that's probably not going to do right now, and it's much better to just get out of the trade, collapse the trade, than to let it hit your stop loss when you already know it's probably not going to go there. So that's why it's like, it's like a pride thing for a lot of traders. They're like, I really want to be right, but that wanting to be right makes you lose a lot of money, I'd say. See how it's just like it's going down, yeah, but it's like going down really slow and keeps on taking out its liquidity, which for me calls for a retracement. When price keeps on taking, keeps sweeping the liquidity, a retracement is due at some point. Not always, but usually. Probably. So this is all about probabilities. Like right now, if price really wanted to go down there, it would just snap a candle right to the consequent encroachment of my target and then just go back. But it doesn't really want to. See, I'm kind of outlining there how many times it's taking sell side liquidity, and it's done it more than that. You just can't see on the screen. See, so that's how, like, in real life, when I was actually taking this trade, when I move my stop loss to break even, that's me saying I'm not in a high probability setup right now, so I'm gonna protect my capital. which is, I mean, it's not really impressive. I guess you can say it's a losing trade, but it's not really a losing trade unless you lose money on it. It's just you had bad timing. In this case, it was just me having bad timing, and I'll show you what I mean at the end of the video. But it's such a, I feel like it's a good skill to know, like when you're in a losing trade, to get out early instead of letting it go all the way back up to your stop loss just because you want to be right. The fix to like collapsing your trades early is just getting in the absolute best setups. But sometimes they're just not there, and you want to trade anyways. So that's like, I don't know. Not every day is a trading day, but for me, I make every day. I force myself to try to at least find one decent setup a day. But some days there's just not, and I take it anyways, and those are the days that I lose. Cause not every day is a trading day. Some days there's like huge news drivers that are really bad for the market, and you don't know what's gonna happen. It can rip hundreds of candles one way, or it can stay within like a 30 candle range for hours and hours. So using the economic calendar really helps you plan out what trading days are going to be easier to navigate. Because you never want to, it's like betting against a casino already. Like, you never want to be in even worse odds. So there I collapse a trade because I'm like, no, it's already swept liquidity too much, and if it hasn't hit my target now, it's probably not going to hit it. So bang. Okay, now look, the red and blue arrow to your left, that was the trade I just collapsed when it failed to reach my target. See that? That's the trade that collapsed, and I collapsed it. Obviously I was right in collapsing it because I would have got stopped out there. See, I'm just showing you where I got it in on the sell side and balance, buy side and efficiency. And then that was my target. It was close. It was going towards it, but it never hit it. There I'm outlining how many times it took the sell side. That's what made it improbable for me. And then here, at a different time of the day, another macro, after it took a big buy side liquidity sweep, that's when the correct time was. That was the right time to enter. Now I'll show you what I used to enter in a second here. I use an inversion fair value gap. Here you see me looking for it on the right hand side, but it's on the left hand side. I haven't outlined it yet. And then you'll see in a little bit how price goes to my target at the right time. So it's all about, it's not only about knowing where price is going to go. It's also about timing and how you execute. So that's the inversion fair value gap I use. As you can see, it broke through it, tapped it twice, and then broke down. So that red arrow was my position. Got in one contract there, but I didn't record it because I was on my phone. Because it gets really late here and I'm like in bed. I don't want to be on my laptop the whole night. So I did this on my phone. Not a good entry, but that's the logic I used. And then that's where I got out, and I targeted, just to make it easy, I targeted that swing low there. And that's my exit, as you can see. Pretty precise, pretty easy trade, but look at my original target. Look at how price hits my target, it consolidates a little bit, and then moves on. And then that was the New York Open, which was an absolute shit show, as you can see. Alright, that's it. Peace.